Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational trading webinars. We are thrilled to have you all here today and happy to welcome our guest presenter, Vlad Karpel, as well as Keith Harwood here to talk with us all about what every options trader should know about zero DTE. Vlad, Keith, are you with us?
I'm here. Thank you, Natalie.
Thank you, Nelly. How are you?
I'm doing well. Thank you both for taking the time and for being here today. We are excited about today's presentation. So, Vlad, if you are ready, you can go ahead and share your screen and pull that up, and we will go ahead and get going. As a reminder to everyone in the Zoom room live with us, if you have questions regarding the presentation topic, please go ahead and type those questions into the chat box or the Q&A, and we'll get those questions over to Vlad or Keith to address. All right, Vlad, I can see your presentation, so you can feel free to begin whenever.
Sounds good. You guys can hear me? Perfect. Again, Natalie, thank you. Thank you to Avant-Garde Trading for having us again to talk about 0 days till expiration options. I'm excited about this topic. There's been exponential growth in these options, and we already seen some of the active traded stocks like Nvidia has not only weekly options, but also kind of a weekly option, kind of almost a 0 days till expiration options. So I think that's where the industry is heading to. So we're going to talk about pros and cons of using 0 days till expiration options versus weekly versus monthly, and what are the main differences. For those of you who are new, welcome. All right, I think we have another record of attendance. I love this. Thank you for joining. But some of you are familiar faces, some of you names, some of you are new. So my background has been in technology. I worked as a consultant and investor in several fintech companies here in Chicago, including Avant-Garde Trading. And my background is to build technology and build AI models for finding signals and opportunities in the market. Since Options Express went public back in 2007 or 2006, I decided to manage my own money using these signals, and then started TradeSpoon and Yellow Tunnel to provide the signals, provide education, and provide live trading room experience to our subscribers. So I've been doing that for over 20 years. Keith Harwood joined me from Options Hotline. And we've been working together for the past 2 years doing live trading room, but also validating the models, validating the signals, and making sure that we're providing valid signals to the subscribers. Keith, you want to maybe give just a quick overview of your background as well?
Yeah, absolutely. So I started off in the option pits of the CBOE back in 2005. And so zero DTE is, I think, a big interest for me as they become more and more prevalent in these markets. Market makers had some of their most active days on expiration, and so now we have them every day. And so this is a really good opportunity for all of us to, I think, access the options markets with the most finely tuned, pinpointed strategies. And this is a really good opportunity to do that as a result. And so excited about the topic today and discussing with you guys how Vlad and I are approaching these zero DTE trades.
Thank you. Again, there's just a disclaimer. We already showed one disclaimer, but the idea is that we're not an advisors, and we are here to provide general education information purposes only. And you can always pause and read the disclosures. So what is 0 days till expiration? How many of you are trading options? Just want to kind of get background. Or how many of you trading 0 days till expiration options? Or if not 0 days till expiration, then how many of you are just trading options in general? That would be a very useful kind of first step, so we can, see how much time we want to spend explaining calls and what is the call and what is the put.
Yeah, Vlad, we're getting some never reactions, some yes, some no zero DTE, all the way to daily. So a variety.
Perfect. Fred, Craig, Ken, David. All right, Richard. Awesome. So some of you do not trade options. So just quick overview. 0 day still expiration options just talks about the time frame, right? Options has different attributes, right? It's a derivative of underlying stock. Originally was built as a back in 70s, 80s as here on CBOE in Chicago to provide hedges for the stock traders, right, or commodity traders, so they can hedge their underlying asset. And that hedges, just think of it as an insurance, right? And that insurance has, level at what price you want to insure your house or your oil or your Microsoft position, and then the duration, right? House you insure usually for a year. Stocks you can insure for 1 month, 3 months, 6 months. Now, in the past few years, we have weekly options. You can insure based on every week. Or 0 day still expiration talks about that you are, insure building this insurance, or you can buy calls where you think, or you can sell these options, but it's happens to be one session only, right? And you can see it's a very popular product. SPX, SPY, QQQ are growing in volume. NVIDIA, I see a growth in volume, intra-week expiration. And your time frame, you're thinking about hours, right? You can put on a trade in the morning and close it by end of the day and doing day trading. Now that the pattern day trading rule has been kind of retired, and you don't need to have $25,000 account to open and close the trade at the same day. Now I think there'll be even bigger reason for, and the volume on the exchanges will grow, right? So this is more of an active day trading, right? And the key insight here is that it's a pure gamma and theta. The entire premium is extrinsic value that decays to zero by the closing bell, right? So the time decay, basically, you start the day, you can sell out of the money puts, right? You can sell out of the money calls. And as long as the market or the underlying stock does not move to these levels, by end of the day, you have very rapid time decay that takes very quickly. Keith, any words of wisdom in terms of gamma and theta for the 0 day still expiration options?
Yeah, I mean, I think that the biggest thing is that this is obviously built as much as anything as a trading avenue as opposed to those hedges that the options markets were initially built for, right? This is about speculating, trading the markets, taking advantage of intraday movement or lack thereof. And another one that you pointed out, and I think it's crucial to understand, is that with pattern day trading going away, this becomes accessible to everybody instead of being dominated by those without that, with a medium or larger size account, something over $25,000 that don't have to worry as much about entering and closing a trade the same day. You know, a lot of these day trades, maybe it's a $10 profit or a $10 loss on a small trade size. That's not worthwhile for somebody with a small account because it gets locked up by pattern day trading rules. Now that's something that people can do. And that's exciting. And that's going to, I think, improve that volume even further.
Thank you. So some of the differences to keep in mind, again, theta decay, right? Theta it's a time premium, right? You have an intrinsic value and you have extrinsic value. So in the beginning of the day, if you're selling out of the money put on, let's say, Spiders, right? Spiders is trading, what did it close? Let me see right now. Pullback 750. Let's type in Spiders. Start of platform 756, right? So in the beginning of the day, the low was 750, right? That's a round number, you have large open interest at 750, and you want to sell a put, right? Maybe 749 put, maybe 748 put that expires by end of the day, right? You can look at the premium. Right now, there's not much premium in 749, but when it got, let's say, when it did get to 7 in the morning when the market opened 751, you could have probably sold it maybe for 30 cents, maybe for 40 cents, especially VIX, right? We had a sell-off after the Broadcom earnings, right, in the AI names. So there was volatility expanded, right? And there was more premium in the morning, right, when the market opened at 8:30 than it is now. And then you can sell that premium, right? And you can see right now in the 748, that's out of the money put. So there's 2 cents, right? So there's some extrinsic value. 756 is 35 cents, right? So assuming in the next few hours, we close below 756, and then that's the 35 cents. If you go to tomorrow, we have unemployment data, right? And wages and state of the economy will know about the inflation. Then you can go to 750. You can see the extrinsic value is 35 cents. So if you don't think we're gonna break that support level in your puts, you can sell naked puts or a put spread, then you can sell these options, right? And I mean, 76 cents, right? So maybe 10 basis points. You can get 10 basis points overnight, right? That makes sense. So you can either trade today's options or you can trade tomorrow options today and sell premium, right? You can do this on a put spread, on the put side. You can also do it on the call side. So 0-day ratio, the rate at which the time premium decays is extreme, right? Because it's measured in minutes and hours, right? Not in days or weeks. Gamma, modest until the last week, right? Gamma accelerates, right? The rate of change of the delta, the correlation between the stock and the option, right? And then the price of the option on underlying asset class, and this is derivative, right, of the delta. So how quickly the price is moving. And then again, it acts as a stock. 0-day still expiration. If you have in the money option, let's say you have in the money call, right? If you trade in 756, right, and I'm going to select the 756 call, it will move. Well, this is tomorrow. Let's do today, 756 call, right? $1.26. So if we have a rally toward the end of the close, right, we were at 750, now we're at 756. People using this as an opportunity to buy AI stocks and Microns of the world and AMD of the world is cheaper, right? And you think at the close we're actually going to accelerate to the upside, then you can buy 756 call, and there's some extrinsic value, right? 7056.80. So 80 cents is intrinsic value, and there's 30 cents extrinsic value. But if we do have that acceleration to the upside, then the underlying option will move in the same fashion as the underlying stock, right? So that theta and gamma is extremely important. And if you don't know what a gamma is, and this all sounds wonderful, but you never heard about it, you can always go into our the research AI, right? And on Avantgarde platform and just be able to say, what is gamma, or why is gamma important? Why is gamma important for 0 days till expiration options? I didn't do that before, so let's see if it. But it did ask about 0 days till expiration. It gives you high risk, high reward. Extreme sensitivity to price movement, right? At the money options. Non-linear risk dynamics, small time frame to adjust, right? So gamma is extremely important for 0-day expiration because it is measure how quickly the options delta changes, right? The analogy is acceleration, right? When you press the accelerator, press your pedal, and when you're driving the car and you're just accelerating very quickly. And here's why gamma is critical for 0 days till expiration. So you can always ask that questions if you need, a quick refresh course on why gamma is important or why, theta is important. Holding period, we already talked about that this is minutes or hours. Maximum move needed, right? Tiny move, big P&L swings, right? Because of this acceleration, it works in your favor or against you, right? If you buy a call and the stock is not, and the market is not going higher, right? Then you have the move to the downside. IV crush risk, right? Minimal on 0 days till expiration. On the traditional options, post-event, you do have IV crush, like after the earnings. In the middle of the day, if you're buying options and there is no news, not much is going to happen. In the morning at 8:30, when everybody's reacting to the Broadcom news, and initially you have a spike in the VIX, right, in volatility, especially if you trade in NVIDIA, then there is that IV crash after, assuming that the volatility subsides after the market opens, you do have that IV crash. Advantage if you're shorting and disadvantage if you're long. And capital requirement, right? You can place these trades relatively cheap, right? Because there's not a lot of extrinsic value. If you want to buy Spider's call that expires in July, you would have to pay a lot more money, right? Because of that time premium. Keith, any words of wisdom on any of the characteristics of 0 day still expiration?
Yeah, I mean, I think just off of that last point, the cheap, the pennies to dollars. We were looking at some things this morning. Same day 7:55 calls, they were trading like 50 cents, and within 15 minutes they're trading 70 cents. So they go up 40% in a matter of 15 minutes. You don't get that with July or August options traditionally in something like SPY. You got a 50 delta option. If it moves a dollar, it's going to move 50 cents. If the total premium for a 50 delta option is a dollar, we're talking about 50% swings in a matter of potential minutes. So it's going to have big movement. You can scalp them, you can trade around them. And then there are times where the market just sits and all they do is decay. And so that's the risk you're taking, is you got to have that momentum going your way or some movement happening if you're buying. And if you're not moving, they decay really rapidly and they get really cheap really fast, particularly as you get towards the end of the day. So it's not easy, but it's basically just compressing your time frames down into hourly charts, minute charts, instead of looking at daily or weekly charts.
All right. Thank you. Thank you, Keith. So two forces in 0 day till expiration: gamma explosion and theta cliff. On expiration day, two Greeks dominate everything else, right? We talked about theta and we talked about gamma. Theta is time decay accelerates exponentially through the day, right? By 2 p.m., out of the money options are losing 30 to 50% of their value per hour. So something to keep in mind, that this is not a linear function, right? It's accelerating, right? And then gamma peak dramatically as expiration approaches, right? At the money, 0 day still expiration, can see delta swings from 0.20 to 0.80, right? That where options correlation to the stock moves from 20 cents for $1 and move to 80 cents, meaning your directional exposure can quadruple before you can react. Right, so something to keep in mind, that this is not linear, that what happens at 8 o'clock, 9 o'clock, 10 o'clock, 11 o'clock, it's proportional, right? There is accelerations, towards the end of the session. Common 0 day still expiration strategy: long premium, right? You're buying calls or puts, right? Directional bias. In the morning, if you thought this was an opportunity to go long because market overreacted to the Broadcom news, okay, then you can buy calls, right? Define risk, premium paid, massive payout, right? If you bought in the morning, 750 call, well, right now you have, could double, triple your money, right? So you have that non-linear outsized returns on your investment. Theta, what works against you? Obviously theta, right? If the market did not move from 750 to 756, right, to the session high right now, or if it stayed at the same level, or if it broke the 750 support level, right? 750, you can see open interest, 11,000 volume, right? Pretty large volume, pretty high open interest. I mean, nothing out of ordinary, but pretty high on the put side, 177,000, right? So that's a pretty large put volume, and 10,000 open interest, pretty high, probably one of the highest. So that would be, the support at that point, right? Short premium, right? Income. If you're selling put spread or you're selling short put, if you're more aggressive. Personally, in the live trading room, I said, if you start trading, you do not want to sell naked options, right? If you want to be long, don't sell put, buy a call, right? If you want to be short, don't sell call, buy a put, because again, you have to be very disciplined, right? Because you have these outsized move to the upside and also to the downside. If you're long and you're on in your direction, well, you know what your losses are, right? This is just the premium, the time premium and the intrinsic value that you paid. But if you shorted a put, right, if you sold a 749 put and the market instead of dropping 1% would drop 2%, this is where you can have outsized losses, right? So unless you're an experienced trader with a large portfolio, I don't propose to sell naked options. But credit spreads are fine, right? You can iron counters, right? You can sell put spread, you can sell call spreads. Pros theta works for you all day, right? Higher probability of profit. You're going to have more winning trades than losing trades. And define risk if you're doing spread, right? If you're doing spread, if it's a dollar spread on QQQ or spiders, it's the premium that you receive versus the difference in strike, right? That's the maximum loss that you can have. Gamma risk is enormous, right? We know on the short options, if it doesn't go in your direction and you're short, that's where you can have outsized losses. One bad move erases days of gains. It requires constant monitoring. Keith, what do you think about common day till expiration strategies in terms of
Yeah,
product?
and I think the biggest things and we'll kind of get into this, but with the buying premium, one of the big keys is always to remember the odds of success. So, if I came into today saying that that was going to be the low and I started buying the same day 760 or 765 calls in SPY, those don't perform. I still have to buy something that has a real delta and a real probability of occurring. I'm not going to be paying a lot of money for a 760 call. This morning they were like 4 cents, but even after the rally, they're still 4 cents. And that's where people tend to, I think, make their mistake. They look for that lottery ticket for a hard reversal, when really it's about still balancing the odds of success with that potential return. And you get enough return out of a strike that's at the money or just out of the money to not have to go for that big gamble.
Thank you. And you guys are welcome to type in questions. We want to make sure that we give you ample amount of time to ask questions and then be able to answer them. So if something doesn't make sense, or I talk very quickly, I have accent, so I'll be more than happy to answer any questions that you might have. So we talk about some of the examples. Spiders obviously is not at 450, it's at 750, but same idea, right? At 10 a.m., you can buy 750 Spiders call, right, for 80 cents. 11:30, this doesn't say Chicago or New York time or LA, but you get the idea. If it rallies to 451.50, right, take profit at 50% gain or hold for runner, right? Same rules applies whether you're doing 0 day still expiration options, weekly options, or monthly options. You want to be a disciplined trader, right? You want to be a confident trader. And the way you do this, you have certain rules that you write down in terms of what is your target gain, what are your stop losses, what is the maximum amount of money you're willing to risk when you put on this trade, right? You want to be consistent from trade to trade, from day to day. You don't change the amount that you're trying to gain. You don't change the amount you try to lose, right? So if it's 50% gain, if you bought an option for $1 and it came to $2, right? Going back to Keith's point, you have to have a reasonable expectation for the range that the market can trade, right? Spiders, when VIX is below 20, doesn't move more than 1%, right? So when it opened at 750, or the lows were at 751, and VIX is still only 16, the stock cannot move more than 1%, right? Unless Donald Trump comes out and types in that he reached a beautiful big agreement with Iran, yes, then the market can move more than 1%. But unless you have some kind of a black swan event, the option will move in a certain, the underlying asset will move in a certain range, let's say 1%. So that's your expectation. Maybe you can say, okay, maybe half of that range. Maybe I can target for $2 move on SPY, maybe $3 move, right? Like half of that range. But you do have to have reasonable expectations, and you don't want to buy the lottery ticket for 3 cents with the hope that it's going to go to $1, because that happens only, less than 1% of the time. So that's important to keep in mind, is that when do you take profit? When do you have stop losses, right? Um, and uh, uh, and that trading plan and journaling is becoming very important, right? So because you want to make sure you stay disciplined, and you can repeat the process, kind of rinse and repeat. Keith, anything to add on the disciplined profit taking and disciplined loss taking?
Yeah, I mean, I think the biggest temptation with zero DTE options is, one trade works and all of a sudden I'm trading more and more and more because I made money on one trade or I lost money on one trade. And there's no reason to get into that like tilt mode for those poker players where I'm trading more just because I made money or just because I lost money. Trade because you see the reason, not because of the fact that you can. Um, so as long as you stay disciplined, continue the journaling process, that should take care of that. But if you get into that mode of just constantly, oh, I'm going to buy these calls, sell these calls, overdoing the trade and over trading, that's one of the big temptations that I think puts people at risk of making mistakes.
Yes, and a lot of this trading psychology, right? Some people, we're all wired differently, right? Some people like to make decisions in 30 minutes or 5 minutes. Some people don't like to trade. So if it's against your nature to be under time pressure, make quick decisions that span over minutes or hours, then probably this is not something you want to, then you want to trade weekly options, right? Or monthly options. But if you like to make quick decisions, right? And you can build this rinse and repeat type of mentality where it's a mechanical trading, you always see the same setup, right? You look at the right? The way I would usually do it, I look at the high open interest. So if I see high open interest and high volume, and my models are showing that there's going to be a lot of buyers and sellers at that level, once you reach that support level, then you take an action, and vice versa. If we reach 760 and it has high volume and high open interest, okay, I do the opposite, right? So that would be a setup, right? And you always do the same strategy, you always select the same strikes, you always look at that premium that you're getting versus risk that you're taking, right? Usually you say, if I'm selling premium, I want 30%, the width of the strikes, right? If I do $1 spread on spiders, that maybe I'm looking for 30 cents credit, right? Or 20 cents credit. And you always repeat and do the same trade over and over again. So risk rules, key takeaways, small size, right? It's all about position size, right? Especially for 0 day still expiration. It's important for any time frame, but for 0 day still expiration, you always want to decide based on your portfolio. I usually say don't risk more than, this is day trading. I would say don't risk more than 1% of your portfolio. So if you open up an account, and now without 0 day still expiration, you can do it with smaller account. But average account is, let's say, $10,000. 1% is $100. So you can buy a call, right? You buy one contract and you risk $100, right? $150, right? That is maximum your risk, right? Um, and losses compound fast, right? So this is probably the biggest rule. It doesn't matter if you understand theta or gamma. It doesn't matter that you don't understand high open interest or how to, read the tape. But if you're gonna trade the options, I would start with journaling and making sure that you never risk more than 1%. That's why I would not sell naked options. I would wait patiently when you reach certain support level that makes sense to you based on positioning or based on technical analysis. And you just buy one call, right? One contract. You risk less than 1%. And then you see what happens and see if this is something that you're enjoying doing, right? Avoid line chop, low volume. Everybody, Keith and I taking breaks between 11:30 and 1, and so do majority of the traders, right? Most of the action is that first hour of the trading session, and then last 30 minutes of the trading session. Set reasonable profit target gain, stop losses, right? 50%, that's reasonable. Respect, gamma exposure, right? Positioning, where is the high open interest? Where is the volume? At what strike will the prices will be pinned. Don't average down. I mean, don't, if the trade goes against you, what I would do, if usually you would do 1% for account value, then split the trade into two. But you do it ahead of time, and then you can do, dollar cost average, right? Or you can do option laddering. But if your rule is 1% maximum loss and you're down more than 1%, you do not want to put on another trade with a hope that it will reverse and go in your direction. You want to be a disciplined trader and follow the same rules. Keith, anything on rules and key takeaways that
Yeah, I
makes
mean, I think that, and this kind of goes back to one of the questions about setting the profit targets or setting the stop losses. Stop losses are always a little harder to set intraday, but setting a profit target and just having that order working is something I always try to do with short dated options like this. So if I've got an option expiring today and I've got a put credit spread on, I know that I want to close that if it gets down to 2 or 3 cents or 1 cent, whatever my number is. But I have that order working just in case the market runs up and I get a fill, and then we get a tweet at 2:45, 15 minutes before the market closes and the market reverses. So if I have it sitting in there, I have a chance to get filled. If I don't, and I'm trying to squeeze out that last penny, I'm going to put myself at risk of getting subject to that black swan event that can occur in that last 15 minutes. And I think also with that the comment you made about averaging down, I also like that for profit taking on long options. So if I enter a trade and my target profit traditionally is, let's say it's 100% of the premium, I can rest an offer to sell out half of my position at 100% return. Now I've paid for the whole trade. Worst case, I'm going to end up breaking even. And these options move fast. So trying to go to the market and capture that 100%, if I don't have it resting, I may miss by a penny or two and then never get it. So at least have something working for a profit taking level, even if it's not the whole position. And then once I'm filled, I can define my next profit target and again, stick to that trading plan, because there are days where those options will turn from 100% return to a 600% return, and I'll feel like I missed out. But there are also days where that 600% return becomes a 0% return or a 100% loss. And I regret not taking the profits. So you got to be aware that these things move fast, and having those defined rules is going to be your biggest friend when trading these options markets.
Thank you. Thank you, Keith. So again, going back to the AI, you can always go into the research center, right? And you can basically say, if I am bullish, and I think SPY will be higher, right? Tomorrow we have unemployment data, right? Initial claims are stable. People have jobs, employment, it's been stable. So that could be a catalyst if the employment is status quo or got better, right? Because ADP number came in better than expected, their jobs creation actually. Then maybe this is going to be an opportunity and the market is going to rally, right? So if I'm bullish and I think spiders will be higher tomorrow, what strike price should I select for tomorrow's expiration? SPY. And you can do spelling mistakes, probably can still understand. But that would be the idea, right? And then AI can run and basically gives you pros and cons. Kind of you can run your plan, right? And you can actually, I don't know why it thinks spiders is trading at 430. That's interesting. All these AIs thinking about it's 430. But nonetheless, it gives you an idea, right? Advantages in the money call option, at the money, and gives you pros and cons. And you can actually say, please fix example SPY is trading at 7:57 now. Let's see if it's smart enough to do that. Okay, so now it fixed it. Okay, so that would be that would be how you would use the AI to help you come up with the proper strategy, to understand pros and cons for the strategy, and what risk you need to consider. All right. I think now, if you guys have any questions, I encourage you to type them in right now, and Natalie can read them out, and we'll make sure that we'll try to answer to the best of our abilities.
Yeah, thank you so much, Vlad and Keith. I just want you to leave that slide for one moment. If anyone wants to follow up with you all separately after the fact, if people think of questions later in the day or another day, feel free to reach out to Vlad or Keith directly. We did get a good amount of questions. A lot of them were addressed during your presentation, which is always helpful. But a couple of different people were asking about selling puts, talking about the delta range for that. If you or Keith have any opinions on that, obviously it's going to depend on the individual person's risk parameters and their goals, as you both touched on. But we did get several questions regarding the delta on selling puts.
Keith, you want to take this one?
Sure. Yeah. I mean, so usually when I'm looking at selling puts, I start around that 30 delta range. That's usually outside the one standard deviation move. So if I've got confidence, I'm expecting that the market's not going to move down a full standard deviation or more. As we get closer and closer to expiration, right now we're about 2.5 hours away from the close. That strike is going to get closer and closer to at the money, and it becomes more subject to just the sort of that random move if we start to get some movement. So it can be risky later in the day. But if I don't go far enough, if I go too far out, I'm just not collecting any premium. And so 30 delta usually kind of a target. And if I'm doing a put credit spread, I still like to get at least, if it's a dollar wide put credit spread, at least 20 cents. So I'm going to get enough premium to offset when I get a loss. If I'm selling something for 2 cents, I just never really get any value out of that. And when I'm wrong, I get really hurt. So, trying to stay within some sort of parameters of a minimum amount of premium that I'm comfortable with. For me, again, it's about 20 cents, a maximum delta that I'm comfortable with. And usually for me, that's about 30 delta.
Gotcha. Thank you. Another question, just Vlad, to verify on that. I think that maybe a slide or two ago when you were listing all sort of the rules to have and the risk parameters, were those times in Central Time or Eastern Time? Right here, yeah.
I think this is Central Time. This is Central.
Yes.
Okay, great. Yeah, we had a question on that, so thank you. One other question here, pushing up against our time frame a bit, but a question about credit spreads. What is your opinion on a minimum percentage that you might look for on a credit for the risk assumed? Questions coming from Fred.
Keith, you want to take this one too? Or do you want to?
Yeah, so that's that 20% of the spread, I guess. So, if I'm a dollar wide spread, 20% is usually that target point. That way I know that if all things go wrong, I've got 4 times the risk of my potential reward. But I'm expecting a high probability of success when I'm entering these sort of trades. So, and obviously expecting to stop out before it gets to that full premium, but sometimes things happen and it's not possible. So yeah, I think that's generally a good rule from the start with, so as not to create these tail risk events where I'm selling something that's 5% of the max value and have a catastrophic loss of 20x the premium I was trying to collect.
Gotcha. Thank you so much. And yeah, it's we are pushing right against our time frame here, so we're gonna wrap it up. But again, if anyone has additional questions for Keith or for Vlad, they can reach out to, thanks, Vlad, reach out to you directly and get those follow-ups. And this again is recorded, and it'll be posted sometime tomorrow for you to access and rewatch at your leisure. Just want to remind everyone to come check out Avant-Garde if they haven't already. If you're not already a client, I invite you to peruse our site, consider opening an account, get access to program trading, that great AI tool that Vlad was demonstrating on the platform. Reach out with any questions regarding that stuff to the team at Avant-Garde. You can do that at info@tradeagt.com. There is a question coming in about the presentation. The presentation today is recorded, and you will all get a link that's going to be sent out tomorrow to watch at your leisure. So please feel free to do that. Vlad, Keith, thank you very much for taking the time to present this afternoon. I know it's a lot of work to make these, and we do appreciate you doing so and coming to talk with everybody. And thank you to those of you who attended live and asked really great questions and were involved. It's always great when it's interactive, so we do appreciate that. And we will definitely hope to see you all back here next week for our next free educational webinar. And until then, keep monitoring that education page, check your emails, and we will see you at the next one. Good trading to all. Thanks, Vlad. Thanks, Keith.
Thank you, guys. Thanks, everybody.